This time it's different for emerging markets. Here's why. So let's look at the chart on the right there. What we're looking at is cross-asset breadth signal for emerging markets. So we're talking about stocks, bonds, and currencies. And that indicator, the breadth indicator, is making a sharp move higher from washed out levels. This is basically the point where the market made up its mind that the Fed is done on rate hikes and that the US dollar has peaked. But importantly, it also comes from yet another reset in sentiment down to extreme pessimism, which in this case we can look at as a contrarian bullish signal given the macro catalysts in play. But what is also key on the monetary front is how emerging market central banks are pivoting from rate hikes to rate cuts. And this makes sense. They were the first to hike and they hiked more aggressively, and now they are done and moving to ease policy. This is going to be a key tailwind to emerging market assets, both stocks and bonds. Meanwhile, this is all set against a backdrop of cheap valuations for emerging market equities. So while being bullish EM equities was consensus at the start of this year, and it's probably going to end up being another consensus call at the start of next year, it would be wrong to ignore the upside and indeed what is actually different this time on the macro front.